Greetings, Dr. Jeffrey Scott here, and this is my weekend market update for August 27th, 2023. Although I'm doing this on Saturday the 26th, I hope to post it sometime this afternoon. What a week in the markets. Yet, you look at what happened, it was kind of not much. It was just a lot of volatility during the week. I title this, Will Thursday's Bearish Reversal Lead to September Pain in the U.S. Markets? My email address typically is hgsidoc@gmail.com. For multiple reasons, I'm going to be migrating to jeffrey.scott@topdowntrader.com. I'm actually building out a website, which I've never had, to showcase some of my tools and videos. So love to have you come check that out when I launch it. Right now, it's just a new email address. So let's take a look at the markets. Now, this is the video that I do predominantly using Wealthcharts, which remains, if not my favorite, one of my favorite tools. I think I'll put one of, because I think there's 2 or 3 tool sets that I like. But if you are to check out my computer during the week, and I do most of my analysis end of day, you're going to see Wealthcharts on one of the screens. I guarantee it. So, and without further ado, let's get started. This is for educational purposes only. Anything I recommend should be in the spirit of education and not investment advice. I am a doctor, not a broker. I am independent. Yes, I am on Wealthcharts, and I am so appreciative of that. But I'm independent of that platform. If you buy Wealthcharts, I think you're a smart person, but it doesn't mean I get any kind of benefit, although I do sell my own package there. I paid for tools that I use, and trading involves risk, and you alone are solely responsible for any investment decisions you make. Okay. Live webinar. I don't do these often, but typically it means my wife's out of town or my grandkids not around, and it's going to happen Wednesday night, August 30th at 8 p.m. I plan on doing this for up to 2 hours. People that register will get the recording. I'm going to demonstrate my approach to top-down investing. I'm going to identify potential trades if they are available and review my favorite option strategies. I'm also going to publicly introduce my tool sets, my Wealthcharts, CAT scan, and indicators. We'll have a Wealth 365 event coming up soon, and that's when you can purchase those. And I've also launched tools for TradeStation and TradingView. There'll be special launch prices, and you can register at, and I'll put this in the link underneath the video. And if anybody that gets email notification of this personally from me, the link will be there. The tinyurl.com top-down doc. So the other thing that you can find me at is daily at stocksanddocs.com. If I'm not traveling, and I'll typically mention it in my video, if I'm not traveling, then expect these to be pre-market almost every day, and especially if something dramatic happened in the market. And sometimes if I'm traveling, I'll put one of these out. This video today, my guess will be 40 minutes based upon the fact that the market is not, in my opinion, conducive to going buy. But these videos that I'm mentioning on Stocks and Docs will last about 4 to 8 minutes. So you always got to start and look at the market. So like I said, this was a volatile week. And frankly, up until Friday, especially with the big bearish reversal on Thursday, it felt like a negative week. But then you look at what we see. We see that the Russell was down 0.4 on the week and the Dow was down 0.5. The NYSE was up a teeny bit. The Spider was up a teeny bit, 0.8, and then the NASDAQ was up a lot, 2.3 and 1.6. This is despite the blow up of NVIDIA. Well, it's sort of a blow up. Why was it a blow up? Well, if you looked after hours, my last print was 514, and I'm not sure that that was the highest it got to. And then it opened up, which would have been up 60, 70 points from the prior close. 50 points from the prior close, and it ended up closing like 40 cents above the prior close. So it really gave up that gap and crap that we had talked about. Now, when you look over here, you could see off the 52-week lows, which from October 13th, you could see almost not quite a year ago. You could see the diamonds are up nearly 20, the NYC's up nearly 19, the Spider's up 26.4, the NASDAQ 34.7, the Q's the big leader up 43, and the Russell, which did break above 20 before this latest pullback, is now 13% off the lows. So these markets truly have come off their lows. There has been a big rally, but now what? And if you look down here, you could see that from the 52-week lows, the big laggards have been utilities and staples, and that shouldn't be a big surprise, followed by real estate because those are defensive. And we've been in a pretty, up until recently, gigantic rally in the markets, and um, defensive plays have lagged, as you'd expect. This is a tool from my friend Cigar from superiorprofit.co, and it's called the Q Edge. So I have multiple screens. I focus on one, but then I have things on other screens pretty much constantly that sort of give me market feedback. This is kind of a heads up display on what's happening in the stock market. On the left is my buckets. I'll talk about the buckets later, but let me just tell you, even though we improved from Thursday to Friday's close, there are still 78% of the stocks that are trading below the lower below the midline of the Bollinger Bands in the S&P 1500, and that is not bullish, folks. 22% above, so a bearish tilt. And then if you look at the deciles from below the bands to the 0 to 10, 10 to 20 of the percent B, there are very few stocks, as you can see, above the midline. But the good news is the center is sort of in the middle of the lower half. The center is not below the lower Bollinger Band. So that says we've come off the low some, but we're certainly not giving a signal that we're so oversold, it's time to buy. Now, up here are the S&P groups sectors, the S&P 1500, so they will differ from what you expect to see in the S&P 500. So for example, I believe the S&P 500 sectors were all positive on Friday. The S&P 15 did have minus on communications, financials, and real estate. So you could see 8 out of 11 or 73% of sectors advanced, 69% of industries, and 64% of stocks. I find this very useful because this will show me what the overall market is doing. And early in the week there was a positive day in the market, and I just didn't feel it in the various portfolios I have, whether the ones that I manage, longer term portfolios, or I have banks managing. And then I would look at my heads up display and I would see why. Yeah, because the NASDAQ 100 stocks, which I do own many of, were doing great, but the broader markets were lagging. So I think that's important, and that's why I like this display. Now, if you look over a month, over 2 weeks or over a month, you can see a sea of red. That the last 2 weeks have not been easy in the stock market. You know that if you're a mostly long facing investor. So over the last 2 weeks, 100% of sectors down, 91% of industry groups, and 81% of stocks in the S&P 1500. It is hard to swim upstream when the current is against you. And for the last 2 weeks, if you're bullish, the current was against you. If you want to feel good about being bullish, comparatively, the one-day move on sectors, industry group, and stocks, it was favorable. Am I ready to say all clear? I am not. This is another tool that will be on one of my monitors all day long. Now, I did send Nick, he asked for, I don't put somebody else's tool up there, by the way, and not tell you it's somebody else's tool. So you can see it's Nick Drendel, stocks tricks with Nick at gmail.com. It was less than $50 when I bought this. It's an Excel spreadsheet. It is a great portfolio tracker as well, but I use it for a market monitor, and I gave him my feedback, which is massively positive. I wouldn't mind adding the IWM to the daily recap in the indexes because I still look at that. But there's a wealth of information here. So things that I learned from this about Friday. The markets were up, okay? More importantly, the markets closed in the upper half of their closing range. Many days this week, the markets closed at the lower part of their closing range. This is a much bullish. So if I wanted to be bullish in the markets, this is my signal. And you could see we did get to the point where we approached on small cap growth, ARKK almost 1% down, the Q's almost 1% down. So there was a pretty big recovery off of the lows, and you could see from the open there was a big move, and you could see a bit of the range of the day. It was a pretty big move, big range day. If you look at prices compared to moving averages, you could see all of these indices are below the 50-day. I think that's meaningful. The spider and the diamonds, the slope of the 50-day is still up, but the 8 and 21 is down on everything. Yet, when you go out to a longer time frame, the 200 slope is positive. Well, that tells me that over a longer term time frame, we're moving up, but we are definitely under some pressure short term. This is genius. It gives me the order of the moving averages, and what you want to see is price above the 8 above the 21, 21 above the 50, and the 50 above the 200. Well, none of them are lined up the way you want to see them. Okay, that tells me something. I can look at the various S&P sectors and see how many are above their 5, their 20, their 50. And when you look above the 50, the only S&P sector above the 50-day moving average is, well, excuse me, the only one with more than 50% of their stocks above the 50-day moving average is energy, and all the stocks in the S&P 500 energy group are above their 50-day moving average. That's very different than discretionary, where it's 17%, real estate it's 10, utilities is 7. Okay, that helps me. I look down here and I could see what's going on the 1, 3, 6, and 52 week new highs, new lows. Now, people who follow me know that this 3-month new high, new low differential is something that I track. And when it gets to extremes, I know the market's going to reverse. Then over here, I can look at ranking some of the major industry groups. Again, another of my constructive asks was, I'd like to add my own. Maybe there's more here that I want to see. Maybe something is moving that's not listed here. But what a great tool, because I know what the final was. I know how the move came up after the open. I know where weakness was, home builders, gold miners, China. I can look at 5 days and say, actually, gold miners in China did good for 5 days. Over 200 days, I could see what hasn't, mostly has not worked. So I think that's a valuable tool. This sits on a monitor just like the Q Edge for a reason. Okay. Rates, the two most important things that are going on in the market right now are, to me, rates and the dollar. And let me just make a comment here. I'm talking more in the top part of this than I normally do, turning it perhaps a little bit more into teaching that some of you want, who just want my thoughts. And the reason is simple. I don't want to spend a lot of time telling you what stocks to buy or sell, because I don't have that feeling today. So I'm spending more time in just talking about the markets. So both the 10-year on the left and the 30-year I watch, and both gave a little nubbing turn down, a little bit more on the 30-year. And that maybe that's good. I think this is consolidation during the high. Now, I'll show you on Wealthcharts, we are at levels that are concerning, but they're also levels you'd expect a reversal from. So if these rates come down, good for the market. The issue of recession, I'm now 50-50 on this slide. When you look at the 10-2 and the 10-3 yield curve, and you look at the gray line, which is when it inverts, and you look at that's the black line, then the gray band represents recessions, you can see that typically when we invert rather, we wait till the yield curve reverts or gets back above zero, and that's followed by a recession. That makes sense. The Fed always goes too far. They get the sense the economy is going to slow down. And as the economy is getting ready to go into a recession, they start cutting rates, and the first couple of rates don't fix it. And that's why the yield curve gets better, and then we have the recession following. Well, this is pretty profound yield curve inversions. Does anybody believe that it's different this time and we're not going to get a recession? Now, everybody can be safe by saying, there is a 100% chance we get a recession. Why? Because there's a 100% chance someday, sometime in the future, that we will have a recession. And right now, I think it becomes less imminent, less obvious. Notice here the Fed Diffusion Index. Yes, every time it drops below this minus 20 point, in the past, it's been either during or following a recession. We're now positive on this general activity. That to me goes against the argument of a recession. And then the other thing is a recession soon. This BOA US High Yield Index Option Adjusted Spread looks at credit tightness, and during periods of recession and leading into those periods of recession, these spike. It is not spiking. So we're in the third year of a presidential cycle, typically the best one in the market. So it's not surprising to me that we're seeing such a positive market response. The second thing, we got an election year coming next year. Do you believe the Fed's not going to get pressured up the wazoo to ease in the setting of a worsening economy by those in Washington, many of which will be up for re-election? So if I had to bet, and I don't bet because I don't like to gamble, I would bet that the recession, if we get it, probably is going to be pushed back into the first year of the presidential term or second year of either Biden #2 or God knows who's going to come out of the Republicans, Trump #2. So we'll have to see. So what does that mean to you and me? It means I'm not considering recession right now in what we're doing. Breadth weakens, but not extreme. This is the white stocks above the 200, stocks above the 40. Yes, they both came down, but they're nowhere close to where we've seen all the reversals in the past. Here's the 13-week new high, new low. I'm looking at the percentage of them. And when it gets down to almost no new highs and mostly new lows, market reverses every time. We're not there. So no imminent reversal seen here. Could change in 2 days. Doesn't mean it can't go up. But when you get the signal that this market's going to reverse, hey, it's a good signal. Buckets. Now, I'm looking for extremes. I'm looking for a lot of stocks less than 0, which would be below the Bollinger Band, or greater than 1, that would be greater than the Bollinger Band. Edge Radar is another tool that I use. This is a great, to me, after-hours tool. And it's taken a lot of things that I did 10, 20 years ago in spreadsheets, and now they're done for me automatically. I just hit the button. And again, most of the stocks in the S&P 1500 are below the midline of their Bollinger Bands. Hindenburg-Omen, something taught to me by my mentor Ian Woodward, who was a follower of Bill O'Neill, but Ian sort of developed his own approach to CAN-SLIM, and I've taken Ian's approach and I've made it my approach by making changes that work for me. But the Hindenburg-Omen is a signal that you see at market tops, and it's the kind of thing that should, make you open your eyes and be aware that a correction could happen. Now, interestingly, we confirmed the Hindenburg-Omen on the NASDAQ on the 7th of August, which is pretty much when this market correction kind of happened. All right. On the NYSE, there has not been a Hindenburg, but on both of these, it's an avalanche and new lows, which just tells you the weakness in the markets. Now, this is another Edge Radar tool. It's not really helping me this week. It's showing me ERG, which is a combination of earnings rank, relative strength rank, and group rank, and comparing when you combine those up and you rank them from low to high, how did the market do in the week? You had some outsized moves, which is probably related to some earnings reports. But as I said in the beginning, for all the volatility, it was a kind of a flat week, and that's what this is showing me. Now, this week, it ain't over, folks. We got lots of news. We've got homes and job openings on Tuesday. On Wednesday, we got employment, ADP. We got GDP. We got inventories. On Thursday, jobless claims, but then we got the PCE. Now, Powell made some comments that almost suggested that he knew what the PCE was, but I don't think they get that a week in advance. Who knows? Must be good to be a Fed president. Certainly get to be on CNBC a lot. So you got a bunch of PCE-related news coming out on Thursday, and then Friday you got the monthly unemployment. So big, big, big news. The only thing you don't have on Wednesday, it seems like, is a Fed meeting. I mean, in the week, but those usually are on Tuesday and Wednesday, the reports. So busy, busy, busy news week. Earnings. Still a lot of earnings. We're starting to slow down a little bit. We still got a few more weeks where there's going to be quite a few. So when I looked at this, there's some names here that matter. NEO, Best Buy, Box. PDD is sitting right on support. Will they use earnings as a way to get a big move? You got some technology stocks, OKTA, Salesforce, CrowdStrike. You've got some horrible retailers from a stock perspective, Conn's, Dollar General. Another EV Polestar, Ollie's is a lagging retailer. Can that get out of its funk? You got Lululemon, Broadcom. So a lot of the stocks that look weak to me have earnings coming up, and maybe we'll look at some of those. We'll see how time goes. This is a statement that I made. Others may have made it. It is a judgment call to hold stocks over earnings dates. It is bad judgment to not know when your stock's earnings date is scheduled. Market thoughts. Finished week. We finished the week mixed, with large cap technology leading to small gains on the Qs and spiders, while the the diamonds, not IDA, and the IWM were down slightly. Volumes mostly lower on late August summer week, but the bearish reversal after the NVDA earnings on Thursday, the earnings came out on Wednesday, was higher volume for the Nasdaq. We're going to look at that, and that's one of my concerns. With the gains this week, the S&P and Nasdaq broke a 3-week losing streak. Markets gyrated up and down on news. I'm not going to read all this. The NVIDIA was amazing, and you won't see it in a daily chart because it had a massive gap up when earnings were announced. When it opened well below where it went out in the after-hour session, and then it traded down the rest of the day, closing just above where it closed the prior day. And if you owned a lot of calls or puts, especially out of the money, and this is why earnings season is dangerous, because of implied volatility, the premium in those instruments, which was massive, got crushed. And so you could have been disappointed with the performance. All things considered, the markets did hold up relatively well this week. We're now heading into the last few weeks of August, then week seasonality of September. Big news, as I showed you. So despite the bullish finish on Friday, the major indices are trading below the 50-day moving average. It failed at resistance. We'll look at that. And once again, I think this is a good time to be cautious. Small positions, long or short, with tight stops and cash on the side. And I'm going to be watching the U.S. dollar and the 10-year yield, which will be key. There does remain a lot of cash on the sidelines. It will get deployed. We will get a move higher, but wait for it. I'm going to wait for the follow-through day on the Nasdaq or the S&P 500, and according to the O'Neillians, that's up 1.25% on higher volume than the prior day before I get too excited and commit more than just token amounts of my hard-earned savings into new positions. Again, if you like what I'm talking about, whether you use Wealthcharts, TradeStation, TradingView, I may even look at Thinkorswim and HGSI. I'm going to show you how I come to some of these thoughts, how I find the stocks. I am going to jump around among the different tool sets when I do the video on Wednesday. It'll probably be 90 minutes. Do the live webinar. I'll answer your questions as we go. And I can't wait to show you some of my new tools on TradeStation and TradingView. As most people do, excuse me, the launch of these will be with some special pricing now to small friends and family groups. I launched them about a month ago, and this will be the end of that pricing period, but you'll get an opportunity if you're interested. And lastly, if you like this, come to stocksanddocs.com. Sign up for it. Historically, I've never kept a mailing list. I'm not going to email you and say, I'm doing a webinar. It's not me. I mean, I'm a physician. I have a healthcare technology company. I trade while working for a living. I don't sell tools and education for a living, so I have never kept one. But my friends at becomeabettertrader.com maintain this site for me, which I appreciate deeply. If you sign up for it, I don't even get your information, but you'll get notified when I place them and when the upcoming Wealth 365 events. Let's go on. That's funny. Usually I talk about how this takes about 20 minutes, and it took 24 because I spoke more about what I thought was going on. So I'm starting in Wealthcharts, and I'm looking at a 5-minute chart of the spider. The line down here corresponds to this bar here, which was the last bar on the prior Friday, the close. The line up here corresponds to the high. And you could see between the low to the high, 436 to 445, it was a 90 S&P points, or a 9 points on the S&P 500. You can see we closed at 439, let's just say 440. So we closed pretty much just below the middle of that range. If you look at what happened on Monday, we gapped up, traded down below the open, or below the prior close, and then we rallied and had a strong finish, not on great volume. Tuesday, we gapped and crapped. We closed at the low of the day. Wednesday, we gapped and closed at the high of the day. This is the painful one. Because of the NVIDIA earnings exuberance, it's all clear, even though we had Powell coming the next day. On Thursday, there was a gap. We topped at 10 o'clock and we sold off hard, and actually finishing just above the prior, the low of the week. Friday, little gap, traded down below the low of Friday of the prior week, and then rallied into the close and finished in the middle. So we were all over the place this week, but net, it wasn't a big move. In fact, if we look at the spider, what do you see? You see a lot of tail on the bottom. You see some tail on the top. You see a narrow range between open and close. And what you also see is we're below the 50, which, although it still looks like it's going up, it's starting to flatten. Bigger volume on Friday than we saw on many days this week. That's good to see. The MACD is inverted, but are we getting improving? We are. That's a positive. Now, some of this may have just been the excitement that we saw on Friday. So when we were above the 50 and coming off these highs, what I was looking for was a bounce off the 50, maybe a retest, and go higher. Well, we had a bounce off the 50, a retest, and a break. We've had a failure at the 50, which typically will take us down below the prior low, which we haven't gotten to yet, and then we had a positive day on Friday. Now, I think there's three things that the S&P could do this week. The first thing is it can rally right up to the 50, and then we'll have a decision point. Does it break out and head to prior highs, or does it reverse? I think if I wanted to short the market, it's that run up to the 50 and a failure. What else could it do? It could break out newer highs. It could run up there and fail, or it could break down from here without going any farther, or it could just go sideways. So I'm expecting to see this thing go sideways on low volume, but if it breaks above that 50, I'm going to change my mind on my positioning. If it runs to the 50 and breaks down, I'm going to change my mind on my positioning and may look at more shorts or contra ETFs. Right now, I don't know what it's going to do. How will I know it's changed? That's why O'Neill came up with a follow-through day. 1.25% move, higher volume than the day before, and that might be something to go look at. Here we had 0.7. It was not a follow-through day. So interesting markets. Now you're going to see a similar pattern across the board. We fell below the 50 on the Qs. They finished on Friday at 0.78, well below the Qs. So that's the two majors. No matter, even though they were positive on Friday, they were down on the week, I believe. Actually, I checked that. The Qs were up on the week because they started off lower, but they have both failed the 50-day moving average. The diamonds have failed the 50-day moving average. On Friday, they were up 0.72. The Russell is just struggling, but it's sitting right on support. That's different than these that have just broken resistance. So Russell, will it hold support and come back and challenge the anchored VWAP in the 50, or does it break down? The Russell was up 0.43 on Friday. The VIX, make sure it's got the right date on it. Yep. The VIX had a minus 1.88. It gapped up at the open and closed near the low of the session. So that would be something that should make the bulls feel happy. Now, I drew this rectangle on the dollar going back and looking at these prior highs. March, May, and here we were August. My hope was that the dollar would reverse here, and if it did, that would have been supportive to the market ultimately going higher. The dollar has broke through, it's retested. So right now, the dollar, which was up Friday another 0.14%, is one of my barriers to success to the long side. So I will be watching that. Strong dollar is good. It may be too strong. Commodities. Strong dollar, you'd expect gold and silver to be doing nothing. They actually had a big move up earlier in the week and went sideways for both gold and silver. Silver technically looks better because, hey, it's above its 50. Notice the falling 50 on the gold, and it's starting to go up again on silver. Oil, I wanted to put this in earlier, so let me just stick this in. I like how Wealthcharts improved this tool and made it easier to use. And I'm going to just place it there, and then I'm going to move it. But somewhere, I could probably draw, this was a false break on oil, and it came down hard. But I'm going to watch this because it kind of looks like oil may have put in a reversal candle here, up 1.46 on Friday. Natural gas, we thought it might be breaking out earlier, and it's just come right back down to the garbage it's been. And then the 10-year, similar to the dollar. I went back and I said, that's kind of interesting. That was in October of 2022. That was a big high. We're in the same range here. So the 10 years at a critical area. I would love to see the 10-year break down, wouldn't you? That would tell me, like the dollar breaking down, that equities are probably going to rally. So 10-year, the dollar, critical points. That's why I called them out on my PowerPoint. Weekly market timing, two things: price above the 30-period WMA, daily, and then the bongo. And these are weekly charts, so it's a weekly bongo, has to be green. When both of those occur, it's buy, or at least be thinking about buying. When they're both, if the price is below and this is red, it's think about selling. And when you're mixed, it's neutral. So if I look at the Spider Weekly, prices above, that's red. So if I was to define this, I would put a yield sign. I do not think that this is a buy market by any means, but I'm not ready to go and short everything. How about the Qs? It's hanging above the moving average. The weekly bond goes red. You know what? Hate to say it, but despite the strong finish, until I get a follow-through day on the Qs, I'm going to put the yield sign. How about the Russell? The Russell's red, and it's actually closed below. So the Russell, by definition, shapes, objects, by definition, the Russell has got a sell signal in, but it's sitting on support. So rather than say it's a sell signal, I'm going to put a yield sign next to it because it's worrisome, but it hasn't broken below support. And then the diamond, which was in a buy signal, is no longer in a buy signal. So the diamond is now going to be a yield signal. Why? Because you've got red bongo, even though price is above average. So that is not the same that we've seen over the last several months. This is the most cautious I've been. Although if you are someone that follows me regularly, I talk about two things: market direction and conviction. My convictions come off over the last 3 weeks, and now even market direction is under pressure. I look at a number of breadth things. One of the things I like to look at is a TLT versus the spider. Why? Because it's all that talk about recessions. And what happened in 2020, what happened in 2008, that bonds versus stocks will pop if in the setting of a recession. So if I know that, why don't I just track that? And I do, and there's no signal there. I look at the cap weighted, equal cap versus cap weighted on the S&P. When it points down here, the big caps are leading, they're leading. Same thing on the Qs. When it points down here, the big caps are leading. Now both of these, and especially the Qs, are showing a trend showing me that we're probably balancing out the cap weighted versus the equal weighted. Now down here, this is similar to that BOE tool looking at evidence of a tight credit market. And you could see, again, 2020, this was the temper tantrum, I believe. And then you can go back here to 2008, that this peaks. So it's a way of looking for tightness in credit. We did see some in 2022. It's come down. But to me, that's worthwhile watching. And then 50 versus FANGs, when it's down here, the FANGs are winning. And the Qs versus the Russell up here, the Qs are winning. Just gives me more information. The S&P sectors, here I'm using ratio charts looking at the individual S&P sector versus the spider. I'm looking at the right edge of each of these boxes, and I'm looking for either a long blue line on the last couple of bars showing me strength is coming in, and I'm looking for the things that are closest to the upper right hand corner. It's a weak market. Look how weak staples, real estate, utilities are. If this market is coming down, wouldn't defensive be stronger? So that would be a check mark in the more bullish approach. Technologies come off its highs. Industries holding up okay. Financials came off a little bit at the end of the week. Energy's also been holding up. And if you look down here, healthcare moved up. So technology is not necessarily leading, but that doesn't mean it can't turn around relatively quickly. I go into my scanners, and let's start by looking at the heat map. This is the S&P 500. I mentioned that Friday was a strong day, and you could see strength in the markets, except for NVIDIA and Meta, but they were mostly flat. Broadcom's got earnings this week. Alta had some bad numbers, dropping 5%. So I start there, then I go into Wealth Scanner. And I love this tool because it's basically looking at the individual relative strength of the different whatever you list. And I created a basket of ETFs that I can use to tell me what's working now. The highest score you can get is 850. I've got one thing above 700. It's the dollar. Is this what I want to lead? Absolutely not. Only thing above 500 besides the dollar is SARK, short the ARKK small cap growth. I do have some position left in here. I took some profits on earlier during the week. And then I have a bunch of commodities, gas, commodities, oil. Here's silver, short bonds, here's energy. These numbers are horrible. So there are not a lot of bullish moves in the market ETFs except for the dollar and short Cathie Wood. And the commodities moving up is interesting. You know, the stocks versus commodities story. And when I see gasoline, I think about refiners. So if I want to look at what's bearish, I can flip it, and it's going to look and show me which things are the worst performers, and where I'm looking for arrows coming up on the up arrow would say you're getting worse. The down arrow might say you're actually improving. So bearish dollars is the worst. Well, that makes sense. IBD breakouts, bad. ARKQ, ARKX, social media, IBD 50, ARKK. So these are a lot of growth, a lot of cancelim type things. So, would not surprise me if cancelim stocks were having some struggles with these current market pullbacks. Hence why I have a position in SARK. Now, we all want to find, as James Ropel calls, the candy, the stocks that are moving now. So I developed a scanner, and it was perfected for me by Become a Better Trader in the Wealthcharts team, and it's called the CAT scanner. So I've been trading for a long time. Probably started trading um, in earnest in the late 80s, early 90s. I'm still here. I'm still trading. Um, and I've noticed certain things about stocks. Stocks can go sideways for a long time, chopping around. And unless there are stocks that pay a big dividend and I go into them because I know that dividend, I'm going to want to buy stocks that are starting to move. The other thing is I prefer to buy moving stocks in leading groups. And the third thing is I look at the market. So I just did that backwards for you. I'm going to look at market first, and the market direction is going to determine my aggressiveness, my direction, what I'm thinking. Right now I have no conviction and I'm sort of neutral to the market and not wanting to make big bets until I see a follow through day. All right. Second thing is what industry groups are leading. And I just showed you maybe energy. I talked about commodities and gas. Um, Industrials, I'll tell you a lot of pollution control and electronic components made my list. The insurance companies looked okay, and I'll talk about how I know all this in a few minutes. But conviction, there's no conviction in this market. So market, industry or sector, stock. That's the order I look at. So we've just done that. So now, one of the things that I identified as interesting was gasoline. So let's see if let's go into my energy. So I have sub, drillers, refiners, and integrated. So this is going to eliminate the E&Ps. And does anything come up to my list with a lot of dots? So let me go back to my dot story. And I guess this does have, I thought Devin was, let's go to all the energies. So after years and years of trading, I learned that most big moves occur with certain things. Do I have momentum? Okay. And I have ways of measuring that momentum uniquely. Was there a breakout? All right. What kind of a breakout? I'm looking for breakouts that move away from chop and they're meaningful enough that they're probably not going to be captured within that choppy move. Volume. Volume is conviction. A breakout with volume is much more meaningful to me than a breakout on low volume. And then gaps. And there's lots of types of gaps. And I like the type of gap that Gil Morales and Chris Katcher did. And I've modified it some because I don't like it when the gap finishes in the lower part of the candle. So I will look for signals from those four impulses, and that's going to help drive my chart review. And I'm going to look at the dots, and those dots are those impulses. I want uptrending stocks, so I use I use a trending indicator called the Bongo, which I was part of the development team. I want longer term, which is the middle bar here, the weekly. It tells me it's in a weekly uptrend. Here's Neogen. It's also in a monthly uptrend, but the daily is red. It told me it's a pullback. So what I want to find are stocks in a weekly uptrend that pull back like this one did here and turn green again and give me my dots. That's what I'm looking for. Much more review of that if we do the session, or if you come to my session. I'm doing it on Wednesday. So Devin comes to the top here, and it's below the 200. That doesn't make me very excited. It did take out the 50 and the 17 on Friday. Lots of volume. This is my volume dot. The gap dot would be above it. This is my breakout dot. That's my momentum. This is the squeeze, and when it turns green, it's releasing from the squeeze. And then this is a Wilder PSAR, and these are some single candle reversals. This is my proprietary extension indicator called the high-low indicator. This here is relative strength versus the spider with a moving average. Breaking out is good. And this is OBV. So the only thing I don't like about Devin is it's so far below the 200. It's a 10% move. I expect the 200 to be resistant. It has lots of overhead supply. Like I said, this is not a great setup, but if you believe in energy, you might look at Devin. CPE is another one, and there are things I like better about this one. It's above the 200. It had breakout and momentum. It didn't have the volume. The relative strength is good. The OBV hasn't broken out yet. Again, I might watch this. There's probably a trend line that could be put in this chart across the highs, and a break above this might get me interested. ET, this is one of these things that goes sideways a lot, but the thing about ET and the reason why I like it, I believe it's actually I own some because it's got a 9.6% dividend and it's moved from 8 to 13. So this thing, sideways move, not that exciting. It doesn't have a lot of volume. It did have breakout momentum. So nothing's hit me in saying buy, buy, buy. What other refiners are there? Valero is a refiner. Um, and similar to one of the ones I just worked on, you could probably stick a trend line on this puppy somewhere in here. And a close above that line, I might want to get interested. There's a lot of them. PBF is an older, not an older one, it's one that ran in past markets. It didn't really blow me away on what it's doing here. But again, a similar pattern. It's breaking out from that line. So refiners are interesting. Now, I mentioned insurance. I don't know if I have one. I do have one for insurance. And here are some stocks that are showing up with insurance. Are we in an uptrend? Absolutely. Did we have a pullback? We did. Here it is right here. Are we in a squeeze and breaking out with volume? We are. I like AJ Gallagher in the insurance complex. It's had a big run, but its high jumps at 68, so I could still buy it. Relative strength and OBV look good. Marshall and McClellan, again, breaking out of a consolidation after a pullback. It's the trade I like to take with relative strength and OBV. Don't know who Serious Point is, but I like the pattern. Wow. Broke out, sideways move, and moving up off the 17 on really good volume. So this is what I do. I try and find those industry groups that are looking the best, and then I want to find the stocks that are moving in them. They don't all look good. Sometimes I won't find one, but those are three in the insurance that look interesting to me. Or I could just take a list of high quality stocks. This is called my combo leaders list, and I stick this group into the YouTube remark section for the Wealthcharts users so they can bring it into theirs. I'm going to run it by dots and see what comes to the top. Emerson Electric. All right, kind of reminiscent of the last one, a gap, sideways move and breaking out. Volume, breakout momentum, relative strength and OBV. This is on my buy watch. Intuitive. Sometimes I just wish I didn't know the names because I typically don't look at this stock, but look at this. I've had volume coming in the last couple of days. I am not above 95. My relative strength and OBV look good. I'm coming out of a squeeze with volume breakout momentum. All right. MasterCard and Visa both look about the same. Sort of a cup handle breakout, maybe. Three dots, relative strength and OBV. Veronis was another one I liked. A gap up, a pullback, and a breakout on volume with momentum, relative strength and OBV look good. Again, I don't want to look at the stock while it's coming back. I want to find the stock here. And why am I finding good stocks here? Because I set up a scan that comes with the market with my CAT scanner, where I'm looking for price and volume. You have to have options because I trade options. I want at least one bullish dot. I don't want any bearish dots. I want my bongo daily. The uptrend had to start within 9 bars. I don't want it too far extended. And I need both a daily and a weekly to be bullish. So I bring the candy to the top workday. Here's another one that looks interesting. Now, I'd like to see it get above that, 240. So I probably wouldn't buy this unless it took that area out. But 2 days of big volume breakout momentum, nice pullback breakout, relative strength OBV. What's not to like except for the overhead supply? Here's AJ Gallagher, back to Dickinson. I don't remember looking at this one this weekend. And again, a gap sideways move. Is it getting ready to run? I'm probably less enthused about this one, but it may be fine. There's my Callan and my ET, my Marshall McClellan that we already looked at. Plains Group Holding is another one like ET. Nice uptrend, giving you a chance to buy it with the pullback. Had volume, breakout momentum. And if you look at that close and you look at the dashed line, it's taken out all the prior closes on this chart that we can see. It's either at or taken them out. So this is an interesting place. And again, it's a dividend payer. We talked about CCHJ last week, and it had a nice week, gapping up on Monday and closing at the high of the week on Friday. Uranium has been a strong group, and Brothers is Brown and Brown rather is another of these insurance companies. You know, you think about all the ugly technology stocks. All right, I mean even NVDA, which many of us are holding. Um, you know, yes, it's still done great. Here's the weekly. It's just right now, it's choppy. So, how about to the um, other extent? I have a list of potential bearish stocks, and let's look for bear retracements in a downtrend. I didn't get a lot of them, but Alta is the kind of stock that is it late to short? Maybe. Do I expect it to bounce up? Yeah, and then maybe I short it from a higher point. But this is what I look for. I look for this breakdown of the 50. It failed at the 50, took out the low here, because this would have been the short point, and boom, it went. So I can scan for stocks to the short side. I think that after 3 weeks of pulling back, I think that I didn't say we're overly bearish. I said I'm cautious. I'm looking for that follow through day. I have some contra ETFs working for me, like the SARK, and I know September is a tough month from a seasonality. And even though I did find a list of stocks that I'm going to watch as sort of potential shorts, I am not advocating you go out and short, 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 or buy, buy, buy. And this does not look like this week's list. So let me update that list. So let's go down here to, first I'm going to clean this list up. And then I'm going to go import from a CSV. I'm going to find my shorts. I'm going to choose my file. I'm going to go into my storage, spin, and these are some of the ones that I'm going to be looking at. Now, I tell you, the problem with a lot of these stocks is a lot of them have earnings coming up. Burlington is one of the retailers that did not do well this week. Several of them did. Broke down below the 50, a retest, and then a break below this level would be interesting to me. Lululemon, um, big breakdown. I believe their earnings are this week, so that would make me reluctant to short. Ali is another one that is broken down, whose earnings are this week. Again, pull back and a breakdown. Still the 50 is close, so that's not a perfect one. PVH, another retailer or apparel, breaking down below the 200. I'd like to see a pullback up here, fail, and take out this low for me to get in, but it did that on the bar before, so technically it's already actionable. So I gave you sort of my philosophical approach to the markets. I'm going to go into much greater detail and use various platforms to show you how I maximize the time I invest in the market. And hopefully you'll glean something on my Wednesday video. I'll be introducing those new indicators I'm very proud of, and very special thanks to Praveen and Van who did the programming for me. And we'll see you Wednesday. Trade safe. Let's watch for a follow-through day.